Hi, my name is Stephen from Share Navigator, and today I'm going to show you how to complete a profit and loss table for the bull put spread strategy using the spreadsheet that we've created. So if you don't have access to this spreadsheet, you can go to our website, go to the courses section in the members area and go to the bull put spread course, and you'll be able to download this spreadsheet. So you're going to see here in the first section here, anything that's highlighted in yellow means that you've got to input some type of data here. So we've done an example for you. So the first data point here is the stock is SPY, but let's say you wanted to do it on Apple, you would just change that to Apple. But we've set up an example here with SPY, so we'll just talk you through that. The current price is just where the share price is currently trading at. So SPY was trading at 221.51 when we give you this example. The trade date, today's date is November the 28th. So whatever date you anticipate placing this trade, you would just put in there. The next one is automatically grayed out. So any sections that are grayed out, you don't need to put any data in. So it's a put option. So the bull put spread is obviously we're using put options. The quantity we put in is 3. We can change that to 2 if you wish. And the expiry we're using is December the 16th. Again, you will select whatever expiry you want to use. So remember with the bull put spread, there's two legs to the trade. We're selling a put and we're buying a put. So the first leg we're putting in, the action is to sell, and you put in your strike price. So for this particular example, we were selling the $211 put option and we're taking in a premium of 180. So you will get those quotes from the options broker, or if you're using Finance Yahoo, whatever website you're using to get your option quotes, that's what you're going to put in there. And then the second leg of the trade is we're buying the put option at a strike price underneath our short put. So our action here is to buy, and the strike price is $1 underneath there, which is 210. We could use 208. It depends what bull put spread you're doing. But watch what happens when we try to put in a higher strike price here. We're going to get a warning from the system saying you need to enter a lower strike, because the second leg of the trade, or the long put, always has to be lower than the short put strike price. So we're going to leave it at 210, and the premium we paid out was 153 in order to buy that particular put option. So now we come down to the trading commission section. So your broker will give you that information as you're placing the trade, but if you're trying to guess before you've even placed the trade, roughly apply a 70-cent commission for every contract that you do. So we're doing 2 contracts here, but we've got 2 different options, so that's exactly 4 contracts. So this trade is going to cost us about 280 in commissions. That's a rough guesstimate. But again, when you go to place your trade, your broker will tell you how much the trading commissions were. The net premium per share after commissions. Now, you've placed 2 trades here. So on one hand, we've sold the 211 put and we've taken in 180 in premium. And then at the same time, we've bought the 210 put and we've paid out 153. So that's a net credit for us of 27 cents a share. But if then again, we've got trading costs here, which we must take into consideration. And when we bake them into our formula, it's automatically calculated. That means we're getting a net credit after trading costs of 26 cents a share. Your probability, again, this is another data entry point for you. That will be given to you by your broker when you're placing the particular trade. Any good broker should have options probability calculators for you. So for this particular trade, the probability is at about 87%. So it's a high probability trade. That's why we like this strategy, the bull put spread, especially on indexes. And we like doing this when implied volatility is very high. Now the good news for this, you don't have to do any more work once you've put in that data. Everything else is calculated out for you. So let's go through some of the data outputs. Well, our max loss in this particular trade is $148.80. And that occurs when the share price at expiry falls below the lower strike, which is $210. So that's all we can lose in this particular trade. The next line, our max profit is $51.20. So that's simply equal to the credit we've taken in multiplied by the number of contracts that we've done. And this is achieved when the share price finishes above $211. Our break-even price for the trade is simply the higher strike minus the credit that we took in, which is 210.74. So our break-even point is once we're above 210.74, we're making some sort of a profit in this trade. Anything below that, we start to make a loss. And you can see here we've got our leeway to the downside of minus 4.86%. What does that mean? Well, if you see up here, the current share price is 221.51. And if you think about it, if our break even is above 210.74, that means the share price can fall all the way from 221.51 to 210.74 and we make some sort of a profit. Or it could fall 4.86% and we make a profit. That's why we like these type of strategies. That's why they're high probability strategies, is because the share price can fall and you can still make a profit. Our return on capital in this trade is 34%, and that's simply your profit divided by your loss. Okay, your profit potential divided by your loss potential. So here's some important notes on the bull put spread strategy. We've completed profit and loss tables for you below, so we're going to go through them in a moment. But this trade carries defined risk and defined reward. So that's really good for the novice option trader. And that's why we would encourage you to use something like the bull put spread as opposed to the short put strategy. Because you know exactly what you can lose and make in this trade before you've even placed it. And that's a very comfortable position to be in. If you want to go and reduce your risk, we would suggest you go further out of money with the strike. So in other words, bring the strike prices down even lower. Maybe use the 208, 207 combination for our SPY example. And reduce the width of the strike. So the width of our strikes there is simply the difference between the two strikes there is $1. But when you're trading something like SPY, you can actually do 50-cent increments. So you could do something like the 210.50 stroke 210. That's a lower risk trade. Moving on down then, we get into our profit and loss tables here. So you can see here the share price at expiry here. These are what if scenarios. So we're now assuming it's December the 16th and the share price, for example, is at 201. And we're asking the question, what would that mean for us in terms of profit and loss? So the great news for you is this is all calculated for you, but we want to show you what's behind the numbers so you understand what you're reading. We're doing it again at 208 and 214. And this is a great way to learn options because it gives you a picture of what you can make and what you can lose in advance before you even trade it. So the first thing we put in here is the net credit we've received for the entire trade, which is 51.20. And then we've got two put options to consider that are now at expiry. So if the share price is at 201, you can see we have a value in here of minus $2,000. Where did we get that from? Well, remember, the short put is at the $211 strike. And if the share price is at 201, that means that that put option is $10 in the money, or in other words, has $10 of value in it. Now, we sold two put option contracts, so that would mean it's a minus for us, and it's minus 20. And remember, in the options market, one contract controls 100 shares of stock. So minus 20 by 100 gives you minus 2,000. At 202, it's minus 1,800. At 204, it's minus 1,400, and so on and so forth. And you'll notice there, once we get above the strike, the value is zero, because the put options are out of the money at that stage and have zero value. At the same time, though, we own the long put as well. And at expiry, if the share price is at 201, the value of our $210 put, this is something that we own, so this has a positive value for us. And in this situation, it's $9 in the money. We own two contracts, which gives us a value here of $1,800. At 206, it's $800. At 209, for example, it's $200. And then anything above 2010, there's no value in that particular put option. And then the final column is just our profit and loss at expiry. So this is simply adding up the credit we received, the negative value of our short put at expiry, and the positive value of our long put at expiry. Anything that's highlighted in red here is a loss, and anything highlighted in green here is a profit. So you can see here, no matter what happens, all we can lose is $148.80, and no matter what happens, all we can make is $51.20. So it's really handy to do that exercise, and it's done for you. And this is what it looks like on a chart. So you can see here, our losses are absolutely defined here, and as the share price goes above our break-even point, so are our profits. So you can see it's a defined risk and a defined reward trade. We would encourage you to place lots of examples of the bull put spread in your simulated trading account. If you don't have a simulated trading account, please join Share Navigator. We'll give you your personal simulated trading account. You can practice doing bull put spreads risk-free. And then At the end of every month, we have little competitions where we reward the top traders who get the best return on investment in their portfolio, and we give out cash prizes. It's a great way to learn about trading options in a risk-free environment.